Welcome to your Tuesday edition of Tech Stocks Daily, where we slice through the noise to bring you today's hottest tech news. Get ready for an Apple bonanza with juicy options activity, quirky clock traditions, and some iPhone 16 drama. We'll also dissect why Meta's upcoming earnings announcement has investors buzzing, and how Synopsys is navigating financial hurdles and a strategic acquisition spree. Plus, we'll delve into Intuit's latest AI advancements and market movements. Stick around to find out if you should hold, buy, or sell your Meta stock. Let's get tech savvy. Hey there, tech enthusiasts. Today we've got an Apple-centric bonanza. Let's dive into the juicy details about why Apple is making headlines on the NASDAQ today. Grab your popcorn, because this is going to be interesting. Apple options activity, the market's temperature check. First up, how about we dive into some options gossip? Financial giants have cozied up to Apple's options with some eye-catching moves. Our sleuthing unearthed a whopping 187 unusual trades. So what's the vibe here? About 48% of these finance wizards are feeling bullish on Apple, while 41% seem to be staring down the bearish barrel. The trades include 96 puts worth roughly $5.9 million, and 91 calls valued just a tad behind at approximately $5.8 million. Give or take, it feels like Wall Street is playing a high-stakes game of poker with Apple. Volume and open interest data hint that traders see Apple in a price window ranging from $150 to $250 for the coming quarter. To reinforce their bets, major analysts are sharing their ratings and price targets. Needham is switching gears from a buy to a more conservative stance with a $260 price target, while UBS maintains neutrality at $236. Bank of America is holding firm with a buy rating at $256, and New Street Research throws in a neutral rating aiming at $225. Why 9:41 a.m.? Now switching gears, why was every new Apple gear showing 9:41 a.m. during the last product unveiling? Picture this. Apple's latest Glow Time event highlighted next-gen AI features and unveiled spanking new gadgets, the iPhone 16, Apple Watch Series 10, and AirPods 4. But what's really captivating is the clock, always at 9:41. This quirky tradition dates back to the iconic Steve Jobs. Scott Forstall, Apple's former senior VP, filled us in on the backstory. Turns out, Jobs had a knack for epic unveilings around 40 minutes into the presentation. So, in 2007, he decided to introduce the first iPhone, rehearsing meticulously to hit that 9:41 mark. It stuck, becoming an endearing staple of Apple lore, like the pixel-perfect cherry on a well-baked technological cake. # iPhone 16 drama. In less warm and fuzzy news, analysts from Barclays are ringing alarm bells about the iPhone 16's initial performance. Tim Long hasn't been shy with his underweight rating and gloomy $186 price target. Supply chain intel hints Apple may cut about 3 million units of a vital iPhone semiconductor for the December quarter, possibly the earliest production cut in recent memory. Sales buzz isn't sky high either, with reports of up to a 15% drop in the first week compared to the same period last year. Global availability checks are indicating shorter wait times, a possible sign of waning interest, particularly in crucial markets like the US and China. And check this. Apple's grand AI rollout in Mandarin isn't set until 2025, plus Europe could experience staggered AI introductions till the same year. This means less oomph right out of the gate for iPhone 16, according to Tim Long. To cap it off, if demand keeps dragging, those early iPhone 16 units might just end up gathering dust. The December forecasts are skating on thin ice given the lack of hardware differentiation and AI limitations outside the US. That's all about Apple in today's news marathon. Quite the roller coaster, huh? From playing options poker to tradition-steeped clocks and ominous iPhone 16 warnings, Apple sure knows how to stay in the headlines. Buckle up. It's going to be fascinating to see how these stories unfold. Hey tech enthusiasts, let's talk tech news, and today we're diving deep into why Meta platforms trading under the NASDAQ ticker Meta made headlines. First up, Meta just dropped a new announcement bomb. The company's third quarter 2024 financial results are set to be released on October 30th, after the market closes. Mark your calendars and get that popcorn ready, because this is bound to be interesting. At 2 p.m. PT, 5 p.m. ET the same day, Meta's top brass will be hosting a conference call to discuss these results, which you can catch live on their investor relations website. Let's be honest, we all love to see how our favorite social media giant is doing, right? So why should you care about this quarterly earnings call? It's not just about the numbers, it's about the direction Meta is heading. They'll upload everything from the earnings press release to some snazzy slide presentations, and there's even a replay option for those who can't make it live. Talk about convenience. Now let's talk growth. And no, I'm not just talking about Zuckerberg's vision board for the metaverse. Meta is catching eyes in the investment world, especially for growth investors. This is where Zacks, the financial analytics nerds who know their stuff, come into play. Zacks just highlighted why Meta is a standout growth stock right now. According to their growth style score, which looks deeper than your usual financial metrics, Meta is a top Rico firm. Without getting too wonky, let's break down 3 key rays of sunshine that make Meta a golden pick. 1. Earnings growth. Meta's historical EPS growth rate is at a nice 18%, but the future? Even rosier. We're talking a projected EPS growth of 43.7% this year. In an industry where the average is 27.9%, that kind of performance can make investors' hearts go pit-a-pat. 2. Asset utilization ratio. Okay, I know this sounds dry, but stick with me. This metric shows how effectively a company uses its assets to generate sales. Meta's STA ratio stands at 0.67, surpassing the industry average of 0.57. Let's just say Meta is more efficient than a well-oiled machine in this area. 3. Sales growth. Their sales are expected to grow 19.8% this year versus the industry average of 7.4%. Translation? They're not just spinning their wheels, they're zooming down the fast lane. Lastly, who doesn't love a good earnings estimate revision? Meta's current year earnings estimates have been nudging upward over the past month. This might sound minor, but it's like spotting a unicorn in the financial world. When estimates go up, stock price movements generally follow, like kids chasing an ice cream truck. So there you have it. Meta is not only gearing up for a major financial reveal on October 30th, but it's also proving to be a kick-ass growth stock. Between stellar earnings growth, top-notch asset utilization, and outstanding sales prospects, Meta clearly has its mojo working. Stay tuned, keep investing wisely, and keep an eye on those growth stocks, my tech-savvy pals. All right, tech lovers, hold on to your circuits because Synopsys has been making waves on the NASDAQ today, and not in the way most investors would like. If you've been tracking SNPS, you're aware that they've hit a bit of a road bump recently, down nearly 20% from their 52-week high. To start, Synopsys shares have taken a nosedive of 16.9% over the last 3 months, definitely underperforming both the ZAX computer and technology sector, which dipped only 1.1%, and the ZAX computer software industry, which decreased 2.7%. Ouch, so why the fall? There's a cocktail of issues here. Key among them is the rising cost of revenues and operating expenses. For instance, in the third quarter of fiscal 2024, Synopsys saw expenses balloon to $1.17 billion from last year's $1.01 billion. Alongside this, they're wrestling with stiff competition in the semiconductor and electronic design automation industry's ring. Let's just say it's not easy to stay on top when you're sparring with heavyweights like Cadence Design Systems and Mentor Graphics. It's not all gloom and doom, though. In the third quarter of fiscal 2024, Synopsys reported a 13% uptick in revenues, hitting $1.53 billion. Looking forward, they're aiming for approximate 15% revenue growth for fiscal 2024. Optimistic? Sure. But they've set the bar high with projected revenues nestled between $6.105 billion and $6.135 billion. For those of you who enjoy the nitty-gritty details, their non-GAAP earnings are forecasted to be between $13.07 and $13.12 per share. All right, let's get real. Despite these somewhat optimistic forecasts, Synopsys' design automation segment saw a slowdown, only growing 6% year over year in the latest quarter. Contrast that with last year's 23% boom in the same quarter, and you start to see the challenge. Yet there's always a silver lining, right? Synopsys is in the midst of acquiring Ansys, hoping to boost its silicon-to-systems strategy. Think sectors like automotive, aerospace, and industrial. This move aims not just to diversify, but to magnify their customer base and product portfolio. And hey, acquiring over 15 companies, including Intrinsic ID and Valtrix, over the past 5 years suggests they're playing the long game to broaden their market horizons. Still, if you think now's the time to swoop in and scoop up some shares on the dip, hold your horses. Synopsys carries a ZAX rank number 3, suggesting it might be wiser to wait for a more favorable entry point. And let's not glaze over the valuation. Currently, they're trading at a forward price earnings of 34.82x, higher than the broader sector's 32.33x. That's like paying craft beer prices for a domestic lager. Meanwhile, if you're hunting for greener pastures, Progress Software is sitting pretty with a ZAX rank number 1 and has appreciated 23.2% year to date. So keep an eye on the landscape and test the waters before making your investment plunge. And that's the latest on Synopsys: rising costs, strategic acquisitions, and a bit of a bumpy ride on the stock market. Here's hoping their innovative product lineup and market expansion strategies turn this narrative into a redemption story. Let's dive right into today's top tech news spotlighting Intuit. This software giant has been lighting up the headlines for a couple of compelling reasons. Most notably, the intriguing moves in its options market and some exciting advancements in its AI-focused portfolio. Stay tuned as we unpack all the juicy details. First up, let's talk about the intriguing shifts in the options market for Intuit. Financial pundits have noted a bearish tilt among traders, with 8 unusual trades making waves. In our deep dive, we found that 37% of traders are bearish, while only 25% are bullish. Breaking it down further, 3 put options valued at 135,320s were executed, contrasted with 5 call options totaling $344,908. Big players seem to be focusing on a price range of $400 to $670 for Intuit stock, indicating they're either hedging their bets or perhaps anticipating some rocky roads ahead. Now, while options trading can be a high-risk, high-reward playground, it surely gives us some inkling about the market sentiment. But is this the whole picture? Absolutely not. Let's switch gears to talk about what's happening in Intuit's own backyard. Next up, the news about Intuit's AI-focused portfolio has been increasingly grabbing attention. After all, in the world of tech, if you're not keeping up with AI, you're basically living in the Stone Age. Despite a slight YTD decline of 0.6%, which pales when compared to the Zacks computer and technology sector's impressive 23.7% jump, Intuit is making some big moves. The company's latest advancements in generative AI operating systems, labeled GenOS, have investors and tech enthusiasts buzzing. What's got everyone excited? Think of agentic AI features that beef up personalization, security, and functionality across platforms. Intuit's vision seems almost utopian, with AI integrating seamlessly into TurboTax, Credit Karma, QuickBooks, and MailChimp by 2025. Imagine getting real-time, year-round financial advice, automated business updates, and customized marketing insights delivered straight to your device. Sounds pretty epic, right? However, a journey to the future is hardly a stroll in the park. Intuit's investments in AI capabilities undoubtedly pave the way for more efficient and streamlined financial services, but they've also impacted the bottom line. The company's balance sheet reflects a mix of optimism and caution, with marketing and engineering expenses on the rise and debt levels that aren't for the faint-hearted. Revenue projections for fiscal 2025 indicate growth, with estimates between $18.6 billion to $18.34 billion. Their AI-driven products have already shown promise, like Intuit Assist, which garnered over 1 million users since its 2023 launch. What does this all mean for potential or current investors? Intuit's cutting-edge tech investments might give the company a much-needed boost, but they also come with a hefty price tag. With a current Zacks rank of number 3, it seems the market is adopting a wait-and-see attitude. So what are your thoughts on Intuit's stock movements and AI innovations? Are you excited, skeptical, or perhaps somewhere in between? Let us know in the comments below. Your insights and opinions are what keep this tech talk lively and engaging. All right, tech heads, let's dive into the big question. Should you sell, buy, or hold a particular stock based on today's juicy news? After sifting through the details flashier than a new iPhone model, let's hone in on Meta platforms. So, should you sell, buy, or hold Meta? Drumroll, please. I'd recommend holding Meta. Here's why. The good stuff. 1. Earnings growth. Meta's historical EPS growth rate of 18% and the sky-high projected EPS growth of 43.7% this year are almost as impressive as a viral Mark Zuckerberg meme. This means Meta's doing something right when it comes to turning a profit. Number 2. Asset utilization. With an STA ratio of 0.67 against the industry average of 0.57, Meta is making the best use of what it's got. Think of it as the company doing a stellar job with every gadget and algorithm at its disposal. 3. Sales growth. Projected sales growth of nearly 20% this year signals that Meta's strategies to generate revenue are working superbly, far outperforming the industry's average. They're leading the race, folks. Why hold, not buy? Upcoming earnings report. We've got that Q3 2024 financial results release on October 30th. Ideally, you'll want to get a clearer picture post-results. Will Meta meet, beat, or miss expectations? It's like waiting on test scores to see if you're graduating. Market sentiment. Yes, there's positive buzz from Zacks for growth investors, but the broader market condition and sector performance matter. It's prudent to bamf out your cape of caution until we get those deets. Event to watch. Remember, the earnings call on October 30th at 2 p.m. PT, 5 p.m. ET is a must-watch. Keep your eyes peeled for insights that'll tilt the buy, sell, or hold strategy. The slides and reports they'll upload can be a goldmine of details. Friendly reminder, even though I'm riding the hold train for Meta, always do your own homework before making a move. The stock market's a tricky beast, and your financial decisions should be as uniquely tailored as an Instagram algorithm. All right, keep your investment mind sharp, tune in for those earnings, and get ready to make savvy moves. Happy holding. Wow, what a day on the NASDAQ. From Apple's options drama and quirky clock traditions to Meta's upcoming earnings call, Synopsys roller coaster ride, and Intuit's AI ambitions, it's been a whirlwind. If you enjoyed today's tech insights, make sure to smash that like button, subscribe, and share this video with your fellow tech buffs. Don't forget to tune in tomorrow for another round of sizzling tech news updates. See you then.